To go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. The lady is for turning. Liz Truss's government scraps a cut to the top rate of income tax a day after backing the plan. We are live at the Conservative Party conference in Birmingham. OPEC Plus will consider cutting output by more than 1 million barrels a day. Crude's price surge saps sentiment. Plus, fighting the naysayers, Credit Suisse seeks to reassure investors it can surmount markets turbulence as its shares fall to a record low and default swaps surge.
Tom, a lot going on in the future. So we look at the FTSE futures down 1%, but of course the big story is that reversal of the 45% tax, of course scrapping that. Treasury is actually also signaling a bit of unease with general market anxiousness, but actually I'm looking at traders and they're definitely pairing the BOE rate hike bets after that reversal. So interesting to look at sterling as well.
Yeah, it was 125 basis points or less come November from the BOE. Absolutely to your point that market traders are starting to ease those bets on that decision then to reverse course on the 45% top rate of tax. We're awaiting, of course, more details and more reaction from Birmingham. We'll bring that to you. Currently, the FTSE 100 is down around 1%. The context, of course, globally is that you've seen 3 straight quarters for the S&P 500 US stocks, 3 straight quarters now of losses. That's the first time we've seen that since the 2008-2009 recession. Today, additional concerns about the inflationary impact then of OPEC Plus's plans. They haven't been finalised. We'll get those on Wednesday, but the reporting suggests they could cut by at least 1 million barrels per day. That would be the most since the pandemic. Again, feeding into those recession fears on higher inflation once again. The FTSE 100 now down 1.3%, a drop of 90 points. Over in France, the CAC current lower by 1.2%. The Spanish IBEX, a drop there of 50 basis points, 50 points or 0.6%. Switch it over, see how things are playing out across the currency space then. The focus once again on the pound, given this U-turn from the UK government, the government of Liz Truss. So the pound currently trading at 111. You saw a bigger bump, that's come off slightly. It's range bound now, in fact. Sterling, after gaining as much as 0.8%, come back down to 111, having crossed 112. Futures in the US, no change there. Again, after 3 straight quarters of declines, 3 straight quarters of declines for US equities. There is a little bit of move into the yield spreads in the US, 420 in terms of the 2-year at the front end, and Brent trending at $87 a barrel. That's again, look at that, a 3%. We're watching the big oil companies on the back of this again. They're reporting that OPEC Plus could be cutting production by as much as 1 million barrels per day, at least, according to the reporting. The meeting is on Wednesday. Francine, we also had the inflation data crossing out of Turkey. You've got the lines on that.
Yeah, so the Turkey September consumer price rising some 83.5%. Talk about unconventional policy, Tom. This is something that we've been really keeping a very close eye on. It's very clear that Erdogan will not back down. He's insisted on even lower rates, saying that they'll help reduce inflation. This is not what the textbooks of inflation and economics tell you. It's really an argument that contradicts conventional economic theory. So far, it hasn't been validated by real-world experience, least of all in Turkey. So you can see that annual inflation rising 83.5% in September, and you can see more pressure on Turkish lira. Now, if you look at the sectors on the move, certainly here in Europe, a huge day, as Tom was saying, because of the UK, also a huge day because we now start worrying, and there's Credit Suisse, but also a couple of things on the other side about just some of the bond refinancing, the huge amount of bond refinancing that we would need. And if you look at the sectors, they're pretty much all under pressure. Again, maybe they move on the back of, Liz Truss turning warning and reversing some of the policies put in place, but I have to say it's pretty ugly out there as we have another week of possible economic volatility, and we look at liquidity in the markets.
Yeah, and let's check back in on UK assets and the back of this U-turn from the government of Liz Truss, the scrapping of that plan to scrap 45% tax at the 45% tax level. So the pound currently, you are looking at the pound trading at 111.87. So just a gain of a little over 0.1% for sterling gilts. There's a little bit of move in at the front end. So 414 yields down 9 basis points. The 10-year at 4.01. That's a yield move lower of 8 basis points. The 30-year, so the longer dated maturity, also at 374, move lower by 8 basis points. And as Francine was saying, markets and traders starting to ease that bet in terms of the aggressiveness of the BOE and their rate hikes that they'll need to push through come November.
Yep, 122 basis points of BOE rate hikes. It's what's currently priced in the markets. Now, Liz Truss's government has scrapped, as we were saying, a cut to the top rate of income tax in the UK. Now, the move is a major reversal for the Prime Minister of the UK, which has been in office. She's been in office for just a month, having spent days defending the measure. Now, let's bring in Wei Li, Global Chief Investment Strategist at BlackRock. Wei, good morning. First of all, I mean, we're all kind of, following this frantic news. It's huge news because we thought that she wouldn't reverse on that. Does it actually mean that you can see opportunity for the markets if suddenly they listen to the markets on what they should be done?
Well, this seems to be a step in the right direction, thinking about the previously unfunded tax cuts and fiscal spend, and now the numbers may get closer to adding up, although they still don't add up. But if I look at last week, there are a few things that I learned. First is markets can actually impose discipline again, and fiscal credibility matters again. And also that when it comes to push comes to shove, central banks actually would prioritize market stability in the case of the BOE. So all of that reinforces our conviction that, well, in this world of great moderation coming to an end, and in this world of new regime shaped by supply constraint, actually soft landing is not on the table. In the near term, we expect central banks to be even more focused on fighting inflation so that they are not in the same position as the Bank of England. But in the longer term, we expect them not to go all the way to fight inflation, to bring it down to their targets, because it's shaped by supply.
Wei, one of the lines that stood out from your most recent commentary when it comes to the UK, just keeping the focus there for the moment, the UK now faces different challenges that change fundamentally how we look at UK assets. Of course, you and the team at BlackRock. Does the announcement today change that view? And on the question of gilts, have we seen the upside now for these yields?
I think it's not black and white. It's not either 0 or 100. So what last week also taught us is that fiscal credibility really matters when it comes to evaluating the growth outlook as well as the asset return outlook of the country. So when we are worried about fiscal credibility, when we are worried about balance of payment crises, then the numbers needs to be stressed a lot more, right? So currently we are underweight UK equities. We're underweight gilts market, but we have identified the front end of the gilts market as a place that we would want to receive because of the very high rate hikes expectations.
Wei, when you look at what happened in the UK, so scrapping these tax cuts for top earners, is it really a warning signal to other markets, to Italy, to other new governments, to make sure that they keep the markets on side? And what does that mean for your portfolio?
Well, it does mean that when it comes to fiscal policy, it needs to be quite a lot more thought through, quite a lot more targeted, as well as quite a lot more coordinated with the monetary side of things. So again, taking the UK as a case in point, we had the government pressing on the accelerator, and the Bank of England, in order to bring down inflation, will have to engineer a recession to do that. So they are pressing on the brakes. That's not coordinated policy, right? So as a result of the fiscal announcement, we're not expecting higher growth forecasts, but we're expecting higher rate hike expectations. So you can see how when policies are not coordinated and well thought through, it doesn't achieve the desired outcome, and that's definitely a lesson for European counterparts.
And you're making the argument as well, Wei, that markets have not yet priced in the extent of any recession that would come about as a result of this stronger reaction from central banks globally. That hasn't yet been priced in. to these markets, is your view?
Not at this juncture. So if you look at earnings expectations for developed market equities, we're still talking about mid-single-digit growth for next year and high single-digit growth for mid-single-digit growth for this year and high single-digit for next year. Which, in the context of us entering a recession in the UK, in Europe this year, and in the US next year, there is still a significant disconnect, which is why we're underweight developed market equities at this juncture.
Wait, there's a couple of things, of course, in emerging markets. So there's, for example, elections in Brazil, and it does seem that the right, even if Jair Bolsonaro does not get elected, is taking a lot of the parliaments. Is there any prescription for what you do with emerging markets right now if the dollar goes ever higher?
While the dollar has been really a key kind of sentiment bellwether in terms of global risk on and risk off, and also from an interest rate differential perspective, it has been reacting to the fact that the Fed is moving ahead quite aggressively. So that definitely has been a bit of a headwind for emerging markets. But in the context of commodity exporters and in the context of global growth currently still holding up okay, emerging markets have been performing on a relative basis not too bad. So we currently have a neutral allocation to emerging market versus developed market, sizable underweight at this juncture, and we are keeping that at this moment. But obviously, eyes on global growth slowdown, what that means for emerging market, China slowdown, what that means for emerging market, as well as the strength of the dollar feeding through to emerging market complex as well.
Okay, neutral emerging markets, underweight developed markets. The Bloomberg Dollar Index currently range bound at 13.37. Just briefly checking on the pound, 111 on the pound, a gain of just 0.1%. Whaley, Global Chief Investment Strategist at BlackRock. We're going to get more calls from Whaley after the break. Coming up, Credit Suisse drops as the new CEO, the memo on Friday, fails to calm markets ahead of another new turnaround strategy. We get more on that evolving story next. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
We have to be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points, and so that's what we're doing.
Welcome back to the Open, everyone. We're 12 minutes into the European trading day. This is a picture across the board. First of all, pound erasing some of the losses. Stocks in general, though, are struggling to push higher. This is because we also watch for oil. Now, there's a million things going on. Happy Monday, everyone. It's going to be a tough ride, maybe in terms of volatility. So we did see stocks in general actually have a bit of negative sentiment that persists amid fears that major central banks will do or stop at anything to, of course, keep inflation under control, raising the risk of recession. Then we have oil trading near $82, and then we have, of course, the pound rebounding after Liz Truss's government has scrapped a cut to the top rate of income tax in the UK. Now, the move is a major reversal for the Prime Minister and her government, which has been in office for just a month, having spent days defending the measure. Now, for more, Bloomberg's EMEA News Director, Stuart Wallace. Stuart, great to have you on this huge story. I mean, this is huge because she's defended it for so long. Does it mean that she's listening to the markets, or she's just really worried about the polls?
I think she came into the weekend desperately hoping she'd keep defending it. And we've seen that last week, as you pointed out. It did become increasingly less credible, though, as the week went on. And then when we hit the weekend and some of the most senior members of the Tory party told her very explicitly they would not vote for this in the House of Commons, it became clear that she might lose a vote. Now, if you're a government and you can't get your own budget through, that's not a great look. So is it a great look to come out on a Monday morning before your conference starts and pull your big flagship policy? No, that's not a great look either. But is it marginally less worse than losing a budget vote? Yes. So that seemed to be the calculation this morning, but fundamentally it leaves them with a problem. Look at the market. We had a rally in the pound when this was first announced. That faded within 3 minutes, 4 minutes. So the credibility has not been restored, and it's going to be really hard to see what exactly they'll need to do to restore the market's credibility in this government.
And how cognizant are they of the need to do that? Because some analysts would take the view, and you've got the likes of Martin Moore from the FT calling them zealots, and I'm quoting from his piece, and they're not interested, they're not looking at that market reaction. Is that a misreading?
It does appear to be that way, I would say, because last week we were tossing it up. At one stage, they'd wiped something like $500–600 billion off the combined value of UK assets. That's quite an achievement in a handful of days for a new government. I think, again, when we got to the end of the week, that was clearly in the background, but I think the real turning point was other politicians telling them they didn't have their support, and maybe that's what they're focused on. Should that be the focus?
Stuart Wallace, thank you for coming onto the show and helping us walk through that big story of, at least of the hour, that U-turn from the Truss government on that higher level of tax. They will not be reducing that level, and we'll continue to watch what comes out, of course, of the Tory party conference in Birmingham, where Lizzie Burden is on the ground. Now to a big corporate story for us as well. The cost of insuring Credit Suisse's bonds against default jumped 15% last week. This, as shares in the Swiss bank hit a new record low. They're currently down almost 10% in the session today. The new chief executive, Ulrich Körner, says he needs 100 days to deliver a new turnaround strategy. Joining us now is Bloomberg's Swiss banking reporter, Marion Halftermeyer. Marion, just get us up to speed on what is happening with Credit Suisse. The market's not reassured by this memo then on Friday.
No, we had an unprecedented level of tweets and conversation over the weekend, a lot of speculation as to what's going to be happening with Credit Suisse. Of course, the elevated CDS spreads are not reassuring the market, but let's be sure to put this into context. A lot of banks across Europe have seen their CDS spreads widen as the markets and, the threat of recession is coming. So it's not unique to Credit Suisse, but obviously Credit Suisse, you'll have to have the overlay of all the issues they are dealing with, and we are waiting for the strategic review at the end of this month.
Okay, Marion, thank you so much. Of course, Marion Halftermeyer will continue reporting on this. Again, a reminder, through her reporting, we found out also that the chief executive said the firm was at a critical moment. Now, still with us, Wei Li, Global Chief Investment Strategist at BlackRock. Wei, there is so much going on. Credit Suisse, CDS, swaps, of course, under huge pressure. I don't know whether this is a critical moment for the bank, which I know you probably can't talk about, but whether there's something out there because of these possible perfect storm from all sides that we should worry about in terms of financial stability.
Financial stability, financial conditions. So what we have seen recently is really that as central banks embark on inflation fighting at all costs with raising rates and potentially withdrawing liquidity, something can break, right? It can either break in the form of the economy, it can also break through financial disruption. We see that in the corporate space, but we also see that on aggregate as well. So all of that reinforces our view that in the near term, they're going to try to get as much inflation fighting as possible level under the belt. But at some point, as the damage becomes clear, both in the real economy as well as in financial markets, then they will pause. They will not go all the way to get to the point where they bring down inflation to 2%. Maybe 3 is the new 2. We don't know in this new regime. But we do expect them to pause next year. And that's where we can build a more sustained, kind of more bullish case for risk assets.
And Wei, we've got a chart that shows how liquidity conditions have worsened to kind of pandemic levels, nowhere near the great financial crisis levels. But as you look at those tighter liquidity conditions, how does that inform the way you're looking to allocate? I know investment grade credit is still part of the mix for you and the team at BlackRock. Is that view challenged by these worsening liquidity conditions? And if not, which parts of investment grade are looking most attractive at this point?
Short end of the investment grade market, in the same way that we prefer short-dated government bonds at this juncture. So, of course, the broader liquidity withdrawing environment is a bit of a headwind when we think about broader risk as allocation views. But the reality is also that we have had years of excess. Somewhat of a moderation from here on is to be expected. So not only kind of the magnitude of the withdrawal, but also the speed and the orderly nature or the disorderly nature of withdrawal matters. Currently, we see QT, for example, working its way primarily through term premium, which is why we are short long-dated government bonds. But if liquidity withdrawal were to happen, to use Francine's framing, at the perfect storm when something else breaks, then we could have disorderly market unwind, and in which case even more prudent risk positioning is warranted. But at this juncture, we want to stay invested, because also bear market rally can be one of those really powerful rallies. So we want to stay invested in market, but to your point, credit over equities at this juncture is how we want to position.
Well, I feel like I'm the bad cop. I mean, I'm worried when you look at how much it costs of insuring, Credit Suisse. We know that they have concerns, but against default, I mean, this is something huge. What's the probability of having a Lehman moment in some parts of the market? It could be a margin call. We saw it with the BOE. Again, risks that maybe it doesn't have that much to do with central banks, but individual risks that then become something huge and snowball.
No, that kind of moment is by definition unforeseeable, because we're talking about black swan type of moments. But I would say, though, where we are at this juncture is different from the Lehman moment, is different from the global financial crisis, in that we don't have balance sheet recession. We have a recession likely engineered by central bank tightening in order to fight inflation that is very much supply driven. We don't have balance sheet recession that is kind of permeating across all parts of the corporate space. So our expectation for default is more contained versus what's actually in the price, which is why there is still a little bit of value that we want to harvest. But clearly, eyes on where liquidity constraint is leading to higher cost of insuring against default.
Okay, Wei Li, thank you. Always excellent. Global Chief Investment Strategist at BlackRock. Okay, coming up, oil surge, crude prices jump as OPEC Plus weighs cutting output by more than 1 million barrels per day. That's at Wednesday's meeting. More on that next, and the implications across these markets. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values, and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
If you're not really in that space full time, I think it's very hard to run a successful crypto fund.
Welcome back to the Open. 24 minutes into your European trading day. Happy Monday. Stocks here in Europe currently down 0.8%. There is a move, though, into UK debt. Gilts being bought, yields lower across the curve, and the pound is currently at 112, a gain of 0.3% after the U-turn from the government of Truss on the top rate of tax. Brent is another big story, though. Oil prices down by more than 3%, and we'll get more details on that now, because OPEC Plus is said to be weighing output cuts of more than 1 million barrels a day when it meets in person later this week for the first time, meeting in person for the first time in more than 2 years. That would be the biggest cut since the start of the pandemic. For more, we're joined by Bloomberg's team leader for energy and commodities, Paul Wallace. Paul, let's start with the question as to why they're meeting in person for the first time in such a while.
Hi, Tom. Yeah, it was. It's been a pretty dramatic few days as far as OPEC Plus is concerned. It seems that on Friday night they decided to push ahead with an in-person meeting on Wednesday. We didn't think we'd see a gathering in person until at least the end of the year. We think that the group is planning quite a big cut in output production. And for that to happen, it's going to be easier if the oil ministers, or as many of them as possible, are in the room together rather than just meeting via video conference. And the other thing is we think we could be in for a long meeting because of the complications about cutting production.
But Paul, how big a cut will be needed for prices to stabilize?
Given the bearishness among so many macro traders about the state of the global economy and the state of China's economy, I think we're looking at a cut of more than 1 million barrels a day if OPEC Plus is looking for either a jump in prices or something that's really going to put a floor underneath them. Another thing to watch for is how these cuts are distributed. OPEC is underpumping so much compared to its quotas because of supply problems in Nigeria, Angola, and lots of other members, that if that cut isn't big, a lot of traders will just think that there won't be an actual reduction in supply to the markets, that the